A savings account is one of the safest places to store your money, but in today's economy, inflation is eating your savings alive. The earlier you start investing in assets like index funds and ETFs, the sooner you can start building real wealth. And the best part? You don't need thousands to get started. Welcome to Financial Frontier, where we break down money, markets, and how to build wealth in simple, real-life terms. Whether you're just getting started or want to level up your financial future, you're in the right place. In this video, I'll walk you through exactly how to start investing in the stock market in 2025, even if you have no clue where to begin. Let's start with the foundation. What exactly are stocks, index funds, and ETFs? A stock is simply a piece of ownership in a company. If you own Apple stock, you're a part owner of Apple. When the company does well, your shares go up in value, and you may even get dividends. But the flip side? If the company underperforms, your investment can lose value too. Best for more active investors who want to pick individual companies and are comfortable with risk and research. Now, what if you don't want to choose individual stocks? That's where index funds come in. An index fund is like a basket of many different stocks. For example, the S&P 500 index fund includes the 500 biggest companies in the US, all in one investment. Instead of betting on one company, you're spreading your risk across many. They're also surprisingly affordable. Many platforms now offer fractional shares, meaning you can get started with as little as $5 or $10. Best for long-term, hands-off investors who want slow and steady growth with less stress and lower costs. Next up, ETFs, or exchange-traded funds. Think of an ETF as a mix between the two. Like index funds, they hold multiple stocks, but they trade on the stock market just like individual stocks. That means you can buy or sell them throughout the day, unlike most index funds, which only trade once per day. Best for investors who want a balanced, flexible option, with the simplicity of a fund and the tradability of a stock. Here's a quick breakdown. Stocks, high reward, high risk, more control. Index funds, affordable, steady, great for passive investors. ETFs, flexible, diversified, beginner-friendly. So now that you understand the types of investments, where do you actually go to start investing? Let's talk about the best beginner-friendly platforms and what to look for when choosing one. Some of the most popular platforms right now include Webull, sleek interface and advanced charts; Robinhood, simple and user-friendly for beginners; M1 Finance, ideal for long-term investors and automation public, great for fractional shares and learning as you go. When comparing platforms, here are the key things to keep in mind. Low or zero fees. You don't want to lose money to commissions. Ease of use. The app should feel intuitive and helpful. Fractional shares. Invest in companies like Amazon or Tesla with just $5 or $10. Most platforms have a similar sign-up process. You'll go through a KYC check. Know your customer. That means entering personal info, confirming your identity, and linking your bank account. Then you'll fund your account, usually with a quick transfer, and boom, you're ready to start investing. Choose a platform that fits your goals and comfort level. Remember, the best platform is the one that gets you to actually start. Okay, now that you've picked your platform, let's build your starter portfolio, where your money starts working for you. The key to a strong portfolio? Diversification. That simply means don't put all your eggs in one basket. Here's a solid, beginner-friendly setup. 60% index funds or ETFs, like VOO or SPY. 20% individual stocks. Pick 2 to 3 companies you believe in. 10% dividend stocks for passive income, like Realty Income or AT&T. 10% cash or safe assets, your buffer for flexibility or opportunity. You don't need a lot to get started. With fractional shares, even $50 or $100 is enough to begin. And remember, you don't have to be perfect. You just have to start. Let's apply this to a real-world example. $900 in index funds or ETFs like VOO or SPY 300 in individual stocks, $150 in dividend stocks, $150 in cash or safe reserves. With a 20% return, your $1,500 could grow to $1,800 in 1 year. That's a $300 gain without any active work. Of course, markets go up and down, but this shows how smart investing can grow your money over time. Even small amounts add up, especially if you keep contributing and reinvesting. Now let's talk about the smartest move you can make next. Automate your investments. Most people don't build wealth because they forget to invest, or they wait for the perfect time. Automation removes that stress. Platforms like M1, Finance, Public, or Robinhood let you set recurring deposits, weekly or monthly, and some even automatically invest those funds based on your chosen strategy. For example, set $25 a week to go into your S&P 500 ETF. That's $1,300 invested over a year, without lifting a finger. This is called dollar cost averaging, buying more when prices are low and less when they're high. It's how you stay consistent and reduce risk over time. Think of automation as your financial autopilot. Set it once, and your wealth builds quietly in the background. Now that your money's working, it's time to track your progress and stay consistent. No need to check every day. That'll just stress you out. But once a month? That's smart. Ask yourself, is your portfolio still balanced? Are your deposits going through? Have any major changes happened to your investments? Here's a mindset shift. Become your own financial manager. Pick a day, the 1st or 15th of the month, and treat it like a wealth check-in. Even if you're managing just $100 or $1,000, act like you're managing millions. Build the habit now. Watch your wealth like a pro. You can use apps like Mint, Personal Capital, or even a spreadsheet to track your growth. Some platforms like M1 Finance do it all for you. Here are a few mistakes to avoid. Don't panic sell. Don't chase hype stocks. Don't ignore fees or taxes. Don't invest money you'll need next month. Let's be real. No one is going to build wealth for you. But the fact that you're here, that puts you ahead of most people. You don't need to be rich to start. You need to start to become rich. Whether it's $5, $50, or $500, investing consistently is how everyday people build extraordinary futures. To help you stay on track, we created a free wealth tracker. Download it now at finfrontier.app. Use it to monitor your deposits, growth, and goals like a pro. So what's next? Pick your platform. Choose your investments. Automate your deposits. Review your portfolio each month, and let compound growth do its thing. Drop a comment if you're starting your investing journey, and tell us what platform you're using. Subscribe for more beginner-friendly financial strategies.